Good morning, good afternoon, and welcome to our December webinar. How we're going to answer some of your questions regarding the end of the year. Before we get started, I wanted to let you know that the questions that we are going to be addressing today have come from the different surveys that have been populated after our webinars this year, as well as from our support team and from the email that was sent out inviting you to this webinar. So today, our key takeaways that we are looking to go over with you is how to gain a comprehensive understanding of each process and how they interconnect, recognizing key indicators to monitor potential issues early on, identifying minor problems, which we would consider flares, before they escalate into significant issues or flames, how to maintain a continuous awareness of the organization's overall health, and ensuring financial reporting is meaningful, accurate, and complete. It is my pleasure, as always, to introduce Bob Escara, who is a CPA and a consulting director with us here at Bold Group. It's all yours, Bob.
Good afternoon, good morning, wherever you are. Thanks for showing up. I appreciate it. And if you are one who did not attend or going to get this recording, thank you for spending the time with me. Now, that's a lot to go over in a very short period of time. Quick background on me. I've been in this business for a lot of years. Just to give you some credence in what I'm saying, I've actually done. So I've been in your seat. I know what you need from business intelligence. We do offer training. We offer a month-end review. The difference between what we do and what other third-party accounting services teams do is we train you to leave the training. That is, we essentially kick you to the curb, give you a hug, and then let you go. If you have more questions, you come back to us. But our job is to train you up on what you need to know. And specifically, if there's some specifics, we address that as well. We want you to succeed. And the only way you're going to succeed is knowing what your numbers are, intimately knowing those numbers, and then beating them. Industry metrics are one thing, but knowing your metrics is another thing. I do respond to emails, but I am an old-fashioned guy. If you want to pick up the phone, my contact information is going to be at the end of this webinar. If you have a quick accounting question, I know a lot of people have, I know some QuickBooks customers have that GL account called Ask Accountant. I could be that accountant for you, can ask you where to put stuff. So use me. I am a resource to you. Now let's get going. So we're going to start this off with what metrics you should be using to drive your organization. Now, there is a slew of metrics out there that you may or may not be looking at, but if you are producing them and not using them, I have my 5-point test that if you've been with me before in these previous webinars that I use, it's more of a 50,000-foot view of how your organization is doing. That's the cash, the AR, the AP, the inventory, and the net income. Looking at those 5 pieces of your organization, that gives you a bird's eye view of how your organization is doing overall. The metrics are more of a ground level. They're in the weeds, and those metrics should be driven by you. So if you can move those metrics, then those metrics are useful. They should be movable. But the key is producing timely financials first, because a lot of the metrics run off your financials, obviously. So to that end, we're going to ask a poll question, and to ask if any questions what metrics you are actually looking at. Attrition, gross margins, it's a multiple choice, so select as many as you want. And then we'll look at the percentages, because some of these metrics you should have at your fingertips. I'm going to go through a lot of the metrics that I went through back in the day to give us an idea of how deeply we should get into these metrics. I'm going to show you them all anyway, because I think they're very interesting.
Okay, I'm going to go ahead and wrap it up and then share the results with you guys.
Gross margins, that's good. Annual attrition, annual revenue per employee, not as much as I would have thought. Attrition, not as many are looking at that attrition number. I think that attrition number is extremely important. Productivity percentages, that's pretty good. I mean, you should be looking at how your technicians are doing. And don't know and don't use, that's a good portion of you guys. Oh, the metrics you use are not listed here. I'd love to know what those are. But have that conversation. Give me a call. Let's talk about these metrics and how you can use to drive them. Now, let me talk about some of the metrics. And there's a slew of them, like I said. So we're looking at these metrics across the board. We're looking at how to improve those metrics. Because if you can't maneuver the metric, then it doesn't really matter. We're going to be talking about these metrics in a little more detail in a minute, but I wanted you to see these overall. I wanted to include them on the slide. So if you go back and wanted to utilize these or wanted to figure out how to calculate these, I can also offer you a spreadsheet that could manually calculate these for you. I say manually because you're going to need to put in your financials and some particulars in order to get to these numbers, but you should be looking at them. But again, if you're not producing financials timely, this is useless too. So we need to get the financials that are meaningful, accurate, and timely. That is the key. So let's talk about when I was in your seat, some of the stuff that I looked at and presented to the management team. So I called this a table, the main one being your team goals in the top left, and the other four pieces being the legs of that table with installation, with service, with monitoring, and sales. Sales is going to be listed last on all these slides, even though it really should be first, because sales, without sales, nobody eats. So we need those guys and gals out there doing what they do. So let's talk more specifically about some of these team goals. Now, on the left, these are team goals for the entire organization. Obviously, they feed off the legs of the table, right? The table is only as strong as its legs. So the legs have to be strong. The black terms are the industry used terms. In the blue are the clear, easy, plain English understanding for me. I made it easy for my team to understand how fast are you growing. If you look at that quarterly internal growth rate, it's the excess of monthly recurring revenue over your attrition. So what you're losing compared to what you're gaining, that's your overall growth rate. And hopefully you're gaining more than you're losing. I mean, that's the idea of the game. And then, of course, gross attrition rate. What are you specifically losing? And are you tracking that? It looks like a lot of you are, so that's a good thing. We should be tracking that. Annual revenue per employee is another one of my favorites. Are returning enough dollars? Is there, I mean, are the dollars turning? So there could be some potential benefits for the employees overall. I think that's a useful thing to look at. Time and material revenue to recurring revenue. I think that's interesting. Some of these are just interesting to look at, but they are true numbers. And if you know what your numbers are, then you can seek to improve them. So let's go look at your installation metrics and what you should be looking at. Now, of course, gross margins, and a majority of you are looking at gross margins. Are you doing the right jobs? We have a few different webinars that I've done related to jobs that you should go look at. Specifically, the one I did in January of 2024, it covered year end. And I think it was after year end. Now we're before year end. So this is more timely. I'd go back and listen to that because it's how you track these jobs and how you track them, and whether or not they're making you money. And these jobs are making you money, those are the jobs you should be doing. Installation hours applied to jobs. I think that's the productivity. I think some of you people are looking at that. And that's your hours, your FaceTime hours, your technicians spending in front of a customer. So looking at if I pay an individual 40 hours a week, I want to know if 30 hours for that are in front of a customer, making the organization money. So always like to look at that number. And then looking at the cut-in jobs for the period. Of course, that speaks to gross margins, but the individual jobs, I want to know if they're performing as we anticipated. And if not, why not? This is going to speak to what I'm going to talk about a little later on the it's a problem situation where you're analyzing those problems and why. So that's on the installation side. We also looked at the service side. And these are the metrics that you should have at your fingertips. So your average dollars per service call. I know there's a lot of non-billed service calls, but I found when I looked at non-billed service calls, there's a lot of money that being lost there where it would say warranty and they were under warranty or some other reason. So I always reviewed on a monthly basis all, and I do mean all non-billed calls. Some were obvious and you can easily roll through them, but you should be looking at your no bill calls. The number of tickets you do on a monthly basis. So if you know the number of tickets you do on average on a monthly basis, how many tickets are getting closed, and you know the average dollars per service call, it's easy to project service revenue. So those are two really good things to look at. And I think the last one is how long it takes you to respond. So if you get a customer who calls you And if it's marked critical, obviously you're addressing it. But if it's a non-critical issue, how long is it taking you to get to those customers? Because it matters. I mean, this is the loyalty thing. If the customer thinks you're paying attention to them, they're likely would stay longer. And we'll talk about that more in a few more minutes too. But customers know when they submit the ticket, and you should respond as quickly as possible. These are the monitoring metrics that we looked at. Now, we had a in-house central station, so we looked at the number of systems serviced by employee. If you don't have a central station, you're going to look at the total cost you're paying for that third-party monitoring service by the number of systems serviced. And does that increase based on the number of systems you put in place? So just having your finger on the pulse of that number, I think, is important. And if it increases based on more systems, and when does it increase? Gross margins on monitoring, which I call the true sugar daddy. If you do monitoring, if you install, it's obviously going to produce recurring, and that margin should be in the 80% range or pretty close, or possibly even more. And that is a big one. That's ultimately what we're trying to do and create value within the organization. So having your fingers on that, important. We were able to track transactions for a dispatcher because we had a central station and we could look at those numbers as well as how long those calls lasted. So a lot of good information that's out there that you could put together to help drive your organization. And the last one, like I said, is sales. This is the big piece. And we need these guys and gals on the wall for these sales, because without these sales, we wouldn't eat. So the job needs to be created first. Now, accountants and salespeople, totally different breeds. And I found when I worked within those two organizations, there was a lot of bad blood between the salespeople and the accountants. But we help them succeed. So creating that relationship with that sales team, I know they're different animals altogether, but they should become friends. But you should be looking at quotas. You should be looking at forecasts. You should be looking at pipelines. You know the number of hours you need for your installers, and those salespeople need to accommodate that time. One of the biggest things that we found was that salespeople would go to a customer, they'd sign a customer, and they'd have an installation date. So the salesperson leaves, and the customer understands when that installation is going to be completed. That needs to be pushed off to your installation manager so they know and drop in the timeline. It is a love-hate relationship. I used to call it a marriage, and it takes work, just like a marriage does. But you are the glue that keeps it all together. So metrics are extremely important markers throughout your organization. You should be tracking maybe a goal for 2025 would be just to track 2 or 3 of these, and then slowly grow into more. But again, if you're not producing financials on a routine basis that are accurate, timely, and current, I shouldn't be looking at financials for a previous month, 20 days after month end. It's too long, it's too old. But there's a lot of stuff that you should be doing in between that could help drive the organization. It's not just the financials at the end. It is everything. So what is preventing? So to that end, what is preventing your organization from producing those financials on a timely basis? Because they need to be produced timely. Now, of course, it is stale even at the point they're being done. So the timely review of the transactions involved in those financials on a weekly, daily basis, which I'm sure you guys are all doing. There's little tiny flares that pop up and likely take a lot of your time in a given day. But ultimately, you should always have closing your books in mind. How quickly am I closing these jobs? And to that end, we're going to try to engage you guys a little bit more with the poll question. So do you have a process for handling your month-end financials? I'll beat this thing up and down on a process. And it's likely that 100% of you are going to say yes. That would be my bet, or at least 90% have some process in place. Now, is it the best? Is it the most efficient? I can help you with that. If not, and I can help you drive your numbers. And from an accounting perspective, I'm a big checklist guy. I live with checklists because for some reason I get some satisfaction of checking something off that's been done, knowing that it's been done, and it just gives me that satisfaction that it's done. And then look what else needs to be done. So the answer is yes. 82% of you have some form of process. Now, at the end of this webinar, And a lot of my webinars, I have this month-end checklist that you'll obviously see here. If you want to get an Excel version of that, I can send it to you. Reach out to me, have a conversation with me. Let's talk about your organization, how you're doing, where you should be going, what you could put in place in 2025 that would make things a little easier for you. Now, I talk about the team, everybody getting involved, and you and your seat should be driving that. So I think the installation team, what are they getting done? When do they get it done? Is key. You should have your finger on the pulse of that. Service tickets. What does your service ticket queue look like? How many critical service tickets out there? How many tickets? How old are they? They shouldn't be months old. How is your warehouse? What are there? Do you use spot checks? You should be doing spot checks in some of your inventory, not a full-fledged physical inventory, but at least looking at high moving items, particularly those items that could be installed outside the organization. So somehow slip out the back door and get installed in the neighbor's house, sort of thing. Cameras. I always track the cameras, especially those easily moved cameras. AP processing. Are you paying your bills on time? What does open receipts look like? Are we getting bills? Are bills getting entered without receipts? All those processes are issues. Now, at the end of this, I'm going to give you a cheat sheet that addresses every single one of these departments. That could be extremely useful that I would print out. But if you want an Excel version of it, you can send it out to me. I'm a big Excel guy. AR processing. Are you billing? But more importantly, are you collecting? So you should have your finger on all of this. There's a lot to do on a monthly basis, no doubt about it. But this is the job you signed up for. Recognizing deferred revenue. How are you doing that? And there's two types of deferreds, right? There's job defers and there's recurring defers. When are you recognizing your deferred? When we did our deferred, and we did defer revenue, we'd recognize all our deferred revenue on day one of the month, and then run it again at the end of the month for all those customers you put in place during that month. So processes behind that, again, ticking off as you complete it, which is the best part. And then sales bookings, which I pulled in last, but it really should be the top. Sales bookings, where are they? Where does that pipeline look like? If we've only got a pipeline that's going to take us through 2 weeks, that's a problem. We need to define those. So financials, we talk about financials and timely financials. So I would work backwards on the date you want those financials produced. What do I need to do in specific dates so that I get financials on the 3rd at the end of every single month? I think 3 days after month end, is that realistic? Yes, we did it. I did it. It's possible. And a lot of people do. I remember asking this question in a previous webinar, and a lot of people produce financials very quickly. So they're probably onto metrics, which is the goal, right? Timely financials and then metrics to help drive your organization, because ultimately your job is to become a player within the organization, not simply counting numbers and not looking at them, not reviewing them. I know it's a lot to do, but I would work backwards. Old stale financials are useless. So having your finger on the pulse throughout the month puts you in the game and allows you to make decisions on the fly. Now, let's talk about one of the big questions that came from not only a lot of you, but our support department is, how do I make proper adjustments at year end? Obviously, adjustments at year end belong in the year that they belong to, but I'm specifically talking about retained earnings. Now, retained earnings is different. Retained earnings, just for definition, is exactly like it sounds. Retained earnings is an accumulation of previous earnings, hopefully earnings, but they could be losses too. It does capture those. I consider it a bucket. It sits at the bottom of your income statement. It does unite the balance sheet with the income statement. So it sits there as a bucket on your income statement. At the year end, that net income rolls into retained earnings, and the system automatically does that. So making a journal entry into retained earnings is not the way to do that, because if you make an adjustment directly in retained earnings, not to mention sometimes it doesn't allow you, but you could copy and paste it into retained earnings. It does not give you a true reflection of what happened in the previous year, because if you're adjusting retained earnings, you're adjusting a previous period. And if you're adjusting that previous period, that adjustment should go into the GL accounts that relate to that total. So just for further clarification here, on the left of your screen, you see the equity section of your balance sheet. You see your capital stock, you see distributions to shareholders. you see the previous retained earnings, and then you see the current net income of $85,000 in this year for a total shareholders' equity of 410. Now, the retained earnings is the accumulation of all the colored pieces you see here, the 25, the 340, and the 85. In the center of your screen, you see the revenue generated for 2023, the net of $85,000. And of course, that number is needed to balance your balance sheet through the equity section of your balance sheet. On the bottom section, I show you how that number rolls into retained earnings on day one of the following year. So you see the retained earnings prior rolls in, the distributions given that year roll in, and your current net income rolls in. So what you don't want to do is adjust retained earnings just to retained earnings, because it should be run through the net income. So as you see there, the blue, that 400,000 rolls into January 1st, 2024 of the new year. So that's how retained earnings gets calculated. Now let's talk about how to adjust retained earnings. And this is the part that is rather interesting. Now this is a little complicated, but not really. On your left, you see the balance sheet. You've got total assets of 700,000. This is in thousands, 700,000, and your liabilities and owner's equity is at 700,000. Now your CPA tells you that we need to make an adjustment to retained earnings. Now we're projecting ourselves here. Your CPA now has your 2024 numbers, and he's reviewing those, and he sees retained earnings is off. So he's saying you need to adjust retained earnings by $75,000 for assets that I wrote off in 2023. So just adjust retained earnings. That's what their pitch is. Just do an adjustment to retained earnings and reduce your fixed assets. Well, that's the wrong thing to do. So your job is go back to the CPA and said, I need the GL accounts that make up that retained earnings adjustment. And he's going to tell you, well, there was $75,000 worth of fixed assets that we wrote off, either sold or wrote off. So that's going to be a reduction of the asset, a clearing of the accumulated depreciation, and then we rolled that into your other income, because it's not a portion of your operations. You're not in the business of selling cars. So this should be in the other income statement of your income statement, other income. So now we make the adjustment. We go back to 2023, we reduce our assets by 75,000. So it takes us from 250 to 175, which in turn reduces your fixed assets to 625. And then we roll that adjustment through your net income or other income. So net income is now $10,000, and your liabilities owner's equity is now 625. So you look at the income statement effect, your other expense was 25, and now it's 100. That reduces your net income by 10. Now that number is going to roll into your retained earnings now. You're not going to make the adjustment to retained earnings. You're going to make it to the GL accounts to make up retained earnings. And then you have your retained earnings adjustment. Now, I didn't see any emojis roll through here, so I'm hoping that makes sense. You can give me a thumbs up or a heart or some interaction here that you're getting what I'm throwing out. There's a couple. Okay, I appreciate that. So that is making sense. I do see some thumbs up, so that makes me feel a little better. Feels like a checklist thing to me. So I appreciate that you understand how retained earnings is affected. And it is a very simple process, but it can be complicated. The other way to adjust retained earnings is to simply create another account in the equity section of your retained earnings. Not a fan of this, but if it relates to an older period, it may be your only option. But if you need to adjust an older period that is more than 2 years old, you should call me, because we can still work it out through the GL accounts that make up the retained earnings. The reason I say that is because when you run a comparison, which I strongly suggest that you do, you run a comparison of last year's numbers to this year's numbers, looking for anomalies again, that it's a concept, identify, track, study, and adjust. You're not going to be comparing apples to apples. So if you do it through the GL accounts, you can look at year over year and find those anomalies as they exist. So it is somewhat of a tricky subject, but not really. It's very simple. Just go back to the period that adjustment that your accountant is asking you to make. So very good. Let's move on. Review problems. So now this is how you review potential problems. Now this is where the rubber meets the road. This is you on a daily basis reviewing your books. We're no longer at 50,000-foot view here. We're now in the weeds. Now, again, go look at that webinar we did back in January. It's a good one to look at some of the comparisons. I won't be rehashing any of that, but I did specifically address some of those issues. I'm gonna refresh your memory on what the ITSA is. It's a mnemonic I like to use, and it's the I in ITS is the identify anomalies, either through trends or through metrics that you can use. So identify those anomalies. You're going to track and trace the transactions or processes involved. That's the T. And then you're going to study the variances. So what caused it? What did we do? What was the process that created this? And then you're going to adjust it if necessary. So that's the ITSA. Now, what we're going to see here in a few seconds, a laundry list of items of areas, which I call areas of concern. They're really just subject areas that you should be looking at. And then I used the mnemonic of problem and identified every issue from the P and the R and the O and the B that spells out problem in each one of these areas. So we're going to move to a poll question that says, which area do you have the most problems in? Now, this is a multiple choice here. So select, and based on time, we're going to look at 3 of these. We're going to go over the general ledger anyway, but any of the other issues that you have, now you're going to get the cheat sheet on all of these problems or potential problems that you can apply the ITSA process to. I call it a protocol, but here's what it is. So I'll give you a couple more seconds where you find most of your problems. Because what I'm going to give you, and from a coach's perspective, and I remember when I used to coach kids, then all the kids that didn't show up to practice, I would make sure that the kids were there. We're going to be better than the kids that didn't show up. So everybody that's signed up for this webinar is going to get this cheat sheet of potential problems that you should be looking at, that you can review at your leisure to make sure you know what to look for and what is the potential problem that's causing the anomaly. I'm really curious about this. Inventory, projects, general ledger. Yeah, I would think inventory. I remember the webinar we had on inventory. We had a slew of participants in that one. So inventory is an issue, how that gets handled. We'll specifically talk about that. We'll talk about projects. We're going to look at 3 of these. Inventory. Now, I'm not sure if you guys knew credit cards is the credit card expense. You guys might be thinking that means the processing of credit cards. So we might talk about the credit card expense because that's what that means. Hopefully 31% of you, that's what you're looking for. If not, you can email me. My contact information will be at the end. So here is your list. And that's everything. And hopefully you have 20/20 vision so you can read it all. I'm kidding. When I'm living, these are the areas or the topics that I address problems with or potential problems with. Now we're going to leave it here for a second because I want you to pick up on the color coding. Now the general ledger is the ledger that all this other stuff gets written into. So if you look at the colors, and you can faintly see those colors, but when we talk about the general ledger, you're going to see that the green is recurring. The blue is related to projects, and you see that written to the general ledger. The orange is inventory, AP, AR, credit card expense. The pink is related to jobs and service, as you can kind of let your eye follow the colors around. The light blue is related to project, service, recurring AP, and credit cards. So it took a little bit of time to put this together, but I think it's extremely useful for all the potential problems you're going to see. And then the yellow is related to projects and service margins. So let's address the general ledger first. So we see those numbers straight out. So again, problem down the left. So ITSA, that's the protocol for finding anomalies within your system. The P stands for profit year over year. You're obviously going to be looking at last year's numbers to this year's numbers. That's why that retained earnings adjustment is extremely important, that it's ran through the GL accounts. Because when I do this year over year comparison, I'll be looking at the true numbers, not some number that mysteriously went through retained earnings that should have affected GL accounts. Your recurring test, I mentioned that number is green, so we're going to see that in the recurring bucket. I call this a common sense test. You should be looking at your recurring on a routine basis. Now, these are obviously going to feed into the others, but your recurring common sense test is look at your monthly recurring revenue average, look at your total recurring for the year, and you should be somewhat close. You're obviously, there's adds and subtracts, but it should be very close to what that number is. If it's vastly off, that's a problem. Open jobs and service tickets, something that you should be looking at. Jobs that are open. I've reviewed books with customers that have jobs that are 4 years old, 3 years old, 2 years old. I mean, there might be a reason why these might be construction, might be whatever it is, but again, having your finger on the pulse of those, so we know that these aren't just customers sitting there waiting for us to do something. That's why the open service queue is extremely important. Those critical service tickets, problem codes within service. We'll talk about that in a second too. Extremely important. And then the balance sheet review. And of course, that touches a lot of which is the orange. It touches a lot of those processes across inventory. How do they compare to the subledgers? Very big issues. If subledgers are off, general ledger doesn't work. So you can't trust those numbers. Labor and payroll, which is likely the biggest expense on your income statement. And that's going to address your jobs in service, obviously in admin and executive twos, but understanding what that number is, comparing that year over year, looking at those potential anomalies related to that. Expense allocation, which is the light blue, it touches all pieces and parts. So how are you allocating expenses to your GLs should be consistent. You're going to find that if they're not consistent when you do your year over year comparison, you might have put an expense in one account and in another account in another month or another year. You might need to put some processes around that and make the adjustment to make it equal. I try to not shoot up flares for the Internal Revenue Service. I tend to not have them look anywhere in my direction. So if I give them reasons to look because my allocations are off one year to the next, there's just no consistency. And if they're looking my direction, they might find something. Likely not, but I just don't need them in my business. And then margins by line of business. Now that speaks to service. Your installation should be in that 35 to 40 range. Service obviously a little lower because you are doing some non-build warranty work, and then your sugar daddy recurring. But having those numbers, that also speaks to, on the project side that we've talked about multiple times, is looking at the margins related to each job type. What job types am I doing well? Which ones do I suck at and likely should not be doing? So managing that. Go to the WIP direct expense webinar we did that talks about expertise related to those jobs, because we did a little spiel on that too. Sarah, let's talk about inventory next, because I think that was one of the biggest concerns for most. Now, these are the problems that I found related to inventory. So physicals, how often are you doing them? Are you doing them at all? So I'm assuming, since inventory is a problem, that you're likely tracking it. We do have customers that use our system that don't track inventory, but maintain a balance within their balance sheet. So they expense every purchase and maintain a balance. I'm not a fan of that. I like perpetual inventory. The system has the ability to do that. So as I use parts, it depletes the inventory. Again, I did a spot check, which should be done routinely, of fast moving items, high dollar items. You should have your finger on the pulse of those, especially if there's a lot of shrinkage. If you look at year end and my inventory variance is a large number, that means stuff is going out the back door somehow or not getting directed. I don't like to point my finger at anybody, but I do like to track what's happening with the inventory that I'm purchasing. I know when I put in inventory back in the day, my purchases went down by a large number, nearly 100 grand in purchases year over year, simply because I started tracking that, and everybody understood that, there's a process behind this now, and you have to manage that process. How you receive parts is extremely important too. And a lot of issues that I find with most customers that I look at, are you receiving parts directly to jobs if they're going to WIP? If you bill a job before you've applied parts to the job and you're using WIP, that means your revenue is going down, but it's only taking what you've issued to the jobs. Now, we did that job webinar. I'd go back and look at that if I were you, if you need more insight on that, or you can simply call me and we can talk about it. Obsolete inventory. I think you should consider, especially if you had a dynamic year, like most of the customers that I'm looking at are having spectacular years. So look at whether or not you should be writing off some of this obsolete inventory. Inventory you don't plan on using that you do have. There is a value on your books. You might have some customers that are still using these products, but they're still on your books. Might want to consider writing those off. Have an obsolete warehouse that maintains the quantities with no value. So you still have the use of those parts, but that value is taken down to net income to reduce your net income. So that's something I would strongly consider from the obsolete inventory side, bringing products to a minimum. So maintaining your inventory, running purchase orders, and it really depends on how you're tracking inventory. Are you doing inventory for jobs? So just in time for jobs? I always talk about you might need to order just in case, but maybe not. So it really depends on how you're tracking jobs. If you're feeding jobs from your inventory, you need to maintain a quantity. If you're not, you're maintaining it only for inventory, only for service, then you need to maintain those minimum quantities. Use the system to help you do that. And liabilities and unrecorded liabilities speaks to the PO and receipt process. I can't tell you how many times I've seen bills entered before receipts. Receipts are negatives. Bills when you use the receipt to offset the bill should come after the receipt. Now I don't care when I receive the bill. If their bill is dated before the receipt, it doesn't matter to me. For me, it's when those amounts are received in my warehouse is to me when that should hit your books. So making sure your open POs are being received. A lot of times POs are for jobs. If you're not getting those POs, we can't do the jobs. You can't do the jobs, you can't generate revenue. You can't generate revenue, we can't produce cash. You can't produce cash, we can't pay payroll. So it's all a big freaking circle. So you need to be able to manage all that. Electronic versus physical. Now, in a real life situation, I've got guys that need to do work, right? I gotta pay it. I don't want them sitting around my office drinking coffee and donuts. Not a bad thing, because that chemistry is real. You need to create that chemistry with your team. But what I see is product comes in, a job needs to get done. So it gets received, gets compared to the PO. A lot of times that paperwork never makes it to accounting. So the technician takes that product that was just received today, goes, installs the job. Now the job's installed, it comes back to accounting. And at that point, an assessment should be done from the job costing perspective. Did the parts get issued? So now we're going to go issue the parts before the receipt is processed. That's going to create negative quantities in that inventory, especially if you're maintaining inventory for service only. All of a sudden, you need to bill this job, and billing is important. I need to bill this job, but I need my job costing to be right. So I'm going to issue those parts out of inventory that haven't been received. That's going to create negative quantity. So having your finger on that pulse and making sure that electronic happens quickly behind the physical, what actually happened. And PPV, big one. If you're using standard cost on your items, that PPV is ginormous. So you should be looking at your PPV and making sure you are getting billed. Now, I'm a huge fan of standard costing. But so if you have a positive PPV on your books right now, that means you're holding the standard cost too low on that item. If that item, if it is a negative PPV on your trial balance, that means you are holding it at higher than you're purchasing it at, right? So now that might be by design. So we do have some customers that add 10% for consumables and then write off all wire and connectors and all that. So that might be by design. But if it's not by design, you should be looking at this PPV, especially if it's negative, because that means your standard cost is too low. And if your sales guys are using that standard cost to do proposals, that's a problem. They're using the wrong dollar amount. So inventory can be and is generally a pretty big issue. And that's why a lot of people come to inventory webinars. But these are some of the problems that I've seen in working specifically with inventory, and some of the things you can have your finger on so it doesn't happen to you. If you have any other specific questions, we're going to have a little question and answer at the end of this. But you can also, if you don't want to ask the question there, reach out to me. and we can address it specifically. So let's go to projects and jobs. Now you see the color coordination. A lot of this hits the GL. Now we did a jobs accounting process a month or two ago. I would suggest you go look at that. But the percentage complete is extremely important. You should be looking at your percentage complete and just work with the customer who's actually comparing year over year, and found that their revenue had gone up pretty drastically and their net income increased too. And we couldn't figure out why. And the reason why is because they did a lot of billing at month end, a lot of smaller billings, not large billings, but smaller billings that didn't have any costs associated with it. So they were being direct, they're hitting the P&L directly. And the reason they were billing is because the customer wanted to bill before year end. So they're looking for the expense and you get the income. So we're obviously, if you got income with no expense, that's 100% profit. That's a problem. So there's two ways to fix that. Either move that up to the liability section or make an adjustment to account or do that over under billing to account for the costs that aren't reflected on the P&L. My suggestion would be to move that up into the liability section. It's not money you've earned, so it's much like deferred. So receiving to jobs directly, I think especially if you get preferred pricing on a job, the example would be you go to a vendor, maybe you're going up against a Vigilon and you're using some other vendor. You go to that vendor and ask them for preferred pricing because we want to win this large job. They give it to you. You are not going to run that product through inventory, because if you do, and you're using standard cost, it's going to generate a ginormous PPV based on the discount they provided. So if you get preferred or special pricing on a job from a vendor, you're going to apply that directly to the job so it circumvents PPV. Other expenses, make sure other expenses get applied to jobs, permits, equipment rental. So everything that came out of the proposal, so just making sure those are applied to the particular job they were assigned to. But the break evens are something that you should be looking at too. We talked about this multiple times. Go to the webinar we had a couple months ago, same thing. Labor concerns. Are you applying time to jobs, and how are you applying times to jobs? Are you using the service units? Are you applying it directly? Now, back in the day, I'm going to date myself a little bit. We had our technicians maintaining, believe it or not, Excel spreadsheets. They were doing manual timesheets, and then we were importing them in. That's the cold, hard way to do it. Obviously, field service units make it very easy to do, but that's going to help you with your percentage complete. You know, how are we doing on these jobs? How much labor do I need to complete the remaining jobs? Because right now we're looking at the 11th of December. You should know today how many jobs are going to be closed before the end of the month, based on the number of hours that are needed, based on the parts that are being used or applied and hopefully already ordered, and how many hours you need. And then do you have the number of people to complete that? I mean, you might need to get subcontractors to help you complete this number to get to the number that you need to for income. So labor concerns are always an issue in how you apply that to jobs. Expected completion dates, I think, is ginormous. So if you take nothing from this webinar but using expected completion dates on your projects, I think it's extremely important. It's a field within our system that you put that expected completion date. Like, again, the sales guy is walking away from that customer. The customer has an expected completion date. Put that in the expected completion date field. I could then sort by that expected completion date and look at all the jobs this month. It also allows for projections next month. I can look at all the hours that are needed next month. And if I told my sales guy, yeah, our next opening is going to be the 15th of January, and they start filling those, everybody thinks the 15th of January, and then I got a bunch of jobs that are doing the 15th of January, and I might need to add people in order to accommodate that. So expected completion date gives you insight not only into now, but into the future. So use that, use the anticipated or expected labor needed to complete the jobs. And again, the expected materials used on those jobs. I think that needs to come from the proposal into the job. Every job should have an estimate. So you can compare estimates to actuals. I think that is extremely important to process. All right, problem codes. This is what I talked about earlier on the service side. Specific problem codes. You understand what the problems you are seeing most of, and then reviewing what's causing those problems. Is it an inventory item that I installed that's not performing like it should? Maybe I need to change that part out. And then I want to look at, I'd be able to sort by problem code. So using specific problem codes. And secondarily is using the secondary problem code. We use that for billing purposes. So what would happen was customer would call, we'd schedule a call, technician would go out and do the job, it'd come in, be reviewed by the service coordinator. The service coordinator would then use the secondary problem code that would say ready to bill. My accountant could then go in and look at that, check for spelling. Doesn't need to be a technician to understand this part should have been used because the explanation said this. So using that secondary problem code just says this one's ready to bill. Now my accountant will just need to go in, review, spelling, and bill. And bills go out the door. So that should happen. And now the second one here that I see as a potential problem is any of your service contracts. Where is that revenue getting applied? I like to apply that service contract to my service department. So that'll be part of my service, even though it's part of recurring. So since those are the guys doing the work on most of that, they do the non-billed service tickets, which relates to the revenue. So they get the revenue. Reviewing open service tickets and how long they've been, especially the critical service tickets. Customers with issues, especially during the holidays, pretend to talk to others at holiday parties and talk bad of you. You don't want that to happen. Breaking the cycle. How often is the same customer seen multiple times? Hopefully you have some type of trigger. If I've seen a customer once every month, what's the issue there? You should get notification that this customer was just seen last week or last month. And what is the issue we are not solving? Or are there new issues? Is this a result of installation faux pas or something? You should be looking at customers you're seeing on a routine basis. Your job is just like my job would be with you, is to train you, kick you to the curb, give you a hug, and then kick you to the curb. That's what you're doing with customers. So you're installing a system, give them a hug, and then go about your life, and then everything should work the way it is. They shouldn't be seeing you on a routine basis. Exactly with my training, and I shouldn't be servicing you either, unless there's issues and I want to understand what those issues are. Applying labor to service tickets obviously goes without saying, extremely important, but I do see problems there where labor is not allocated and it just takes longer to complete those. So having those tickets completed and then reviewed by somebody other than who did the service is always a good thing. And the expense side, allocating all the expenses related to that service ticket. Did you need an equipment rail? Did you need a lift at that service? Applying that to the service ticket, not just taking that to the P&L, because I want that through the service so I can look at trends. And then margins on your service ticket goes without saying. Everybody's looking at margins, but your service margins should be defined, should be easy to define if you are doing all the things we said here. Now, there's a lot of these areas that I did not go through, but you're still going to get them within the webinar because each one of these has its own sheet. And they're all the problems that you should be addressing. Actually, Sarah, let's look at this credit card expense to think that maybe we're talking about expense and maybe been talking about credit cards, but this is related to expenses, not to credit card processing. I could probably add another one here related to credit card processing because there's a multitude of problems there, or that could potentially be problems. But here I'm talking about credit cards and how you utilize those. And I'm a huge fan of credit cards. I like the extended terms. If I get 30 days with my vendor and I get 30 days with my credit card, and that's 60 days. Cash is king. I maximize these, especially because on point one, the points, the cash back, worth it. I mean, you're going to be spending the money anyways. Might as well run it through an organization, especially even if you have the cash. I would use the credit card anyway. Just pay the credit card off at the month. I would definitely not pay cash directly. I would maximize the credit cards at every potential opportunity. Reconciliations tend to be a problem with these with credit cards. How are you reconciling it? And it really depends on how you're using it. Are you using the credit card through the system where it adds to AP, or do you have credit cards set up separately? Are you using credit cards as a bank account? I'm a huge fan of using credit cards as a bank account for ease of use, not only for processing transactions through that bank account, um, but for reconciling. So you're reconciling every transaction. I have the ability to export from the credit card company, put it into an Excel spreadsheet, and anytime anybody used my credit card from one of my technicians, I get that receipt. That receipt would go to accounting. I do that export from the credit card company, and every one of those transactions, I'm going to find a receipt to. If that receipt applied to a job, this is again where the expenses happen to it. It might be lunch at the job for some particular reason. You guys allow that to happen. You apply that to the job, or any other expenses. Had to run to Home Depot to get a part. I want that receipt, and I want to know what job that relates to, what service ticket relates to, and that goes to accounting. So when I export these credit cards from the credit card company, I have that amount to allocate to that job. Makes it real simple. Now, the only issue here is the last item here is moving the liability. So the credit card obviously is going to create a negative on your bank account. We want to move that to the liability section, because if you don't, our balance sheet is going to consider that a bank account. It's going to throw it up in the banks, and it's going to be negative. So on a monthly basis, you take it out of the bank, you put it in the liability, you put it into liability code on a monthly basis, and you reverse it the next month. If you're not using credit cards, this helps with month end. And that is the goal, to get quicker numbers. If you use a credit card as a bank, now it sounds a little complicated as I'm explaining it, but it is a very simple process. Especially the reconciliation process in this is very simple to do. So if you need assistance with that, feel free to reach out. We can address that point blank. Now, you're going to get all these cheat sheets, and I think they're all very good. If you find there's a subject that I did not cover, feel free to reach out, because I'll add it. And then we'll go from there to add.
Wanted to share the information with you on how to contact Bob. You can reach out to him via email. Again, he loves it if you pick up the phone and give him a shout, and he can set up some time with you directly. So please take advantage of that. Just a reminder, we do have knowledge bases for all of our products available via the URLs listed here, through the help section in your product, or from our support portal.
See that month-end checklist that I spoke about? It's listed here. You don't need to screenshot it. If you want it, I got an Excel spreadsheet. I've said that before. I can send it over to you. And if you have particular issues related to any one of these, you can reach out to me. But this is the checklist. I told you I love checklists. So you get something done, you get to check it off. So I appreciate your time. Have a happy holiday.
All right. Thank you, everybody.